So this question tells us that Ellis received a $60,000 6-month 10% interest-bearing note from a customer. Now, what did they do? Well, they held on to the note for 2 months, and then they decided, we're in need of cash. Let's discount the note at Antero Bank at 12%, right? So the discount rate is 12%. Since we know it's about discounting a note receivable, we should be thinking about our mental map, and no matter what they ask us, when we perform those 4 steps, we'll be ready to answer the question. So in this case, let's just go through the 4 steps and then come back to what they're asking us about. So here's our 4-step mental map. Take a quick look at it. Pause the video if you need to. Otherwise, let's jump into the 4 steps. So our first step is to calculate the maturity value of the note. And that's the face value of the note plus the interest that will be collected over the life of the note. So the face value of the note is $60,000. And then this is what's tricky, right? It's a 10% interest-bearing note, but that's for a year. This is only a 6-month note. So it's actually 5%. So 60,000 times 5%, that's where we get the interest to collect of $3,000. So 60,000 plus 3,000, that equals a maturity value of the note of $63,000. Now in step 2, we need to calculate the discount amount. So that's the maturity value of the note of $63,000 times the discount rate. Now the discount rate is 12%, but this is after 2 months of holding, and that means there's only 4 months left on the note after it's discounted or sold to Antero Bank. Right, so 12% is multiplied by 4 out of 12 months, which is basically 1/3. So the effective discount rate is actually 4%. So 63,000 times 4%, that equals a discount amount of $2,520. So in step 3, we can calculate the cash Ellis received from Antero Bank for the note. So the maturity value of the note was $63,000. Subtract the discount amount of $2,520, and that means the amount paid by Antero Bank was $60,480. Now in step 4, we compare the cash received from the bank to the face value of the note. So the cash received was $60,480, subtract $60,000, which is the face, and it's a positive number, which means it's interest income. So interest income on the note is $480. So when preparing the journal entry, well, just remember, we're always receiving cash. So start out with debiting cash for $60,480. And then we got to remove that note receivable, right? Because we discounted it or sold it to the bank. So credit the note receivable for the face value, which is $60,000. And then the difference there is the plug basically. And that is going to be a credit to interest income for $480. So that's the journal entry. And those are the 4 steps. So when we go back to what the question's asking, it's asking the amount of cash that Ellis received from Antero Bank and what amount of interest income or expense would be recorded in the financial statements. All right, so we know the amount of cash was $60,480, and they would have credited interest income for $480, right? So that's going to be the correct answer here. So anytime you see a question about discounting a note, think about that mental map, the 4 steps, and the journal entry, and you'll be able to nail any question the exam throws at you.